All right, so welcome to the Frankfurt session, which consists of essentially two panels. One brings together academics gone central bankers or central bankers gone academics, talking a little bit about the policy response of the European Central Bank to the COVID-19 crisis. And this will be moderated by my colleague Hans-Helmut Kotz, who has significantly more experience in monetary policy aspects, and our two great panelists for the first session are Isabel Schnabel. She's a member of the executive board, doesn't need any introduction. She is the academic gone central banker. And then we have also Lucrezia Reichlin, who is now with London Business School, but former was with the ECB. So the central banker gone academic, or just always has been an academic. Without much further ado, I turn over to you, Hans-Helmut, to moderate the session. We'll kick off with Isabel's presentation. Lucrezia is going to respond, and then we have a chat. Thank you.
Okay, vielen Dank, Tobias. Great pleasure to be in this webinar. Great pleasure to be with Isabel Schnabel and Lucrezia Reichlin. Welcome to the audience, of course. Also, I've probably been hired as a veteran of the last crisis. I guess we're fighting now completely different, a new war. This is very much unprecedented what we see here. We see a fall of GDP all over the place. Numbers which came out just 2 days ago from IMF are possibly, at least as seen from a market perspective and economist perspective, as too benign, too complacent. And this time around, the hit will come not via the banking system, via banks and non-banks, but it's concerning first and foremost firms. And nonetheless, central banks are very much at the forefront, and in particular in Europe, they are at the forefront. We have the following setup. Isabel Schnabel will give a presentation of the ECB perspective on what's happening and how to respond, and Lucrezia Reichlin will then comment, and then we try to get into sort of a disciplined discussion. Isabel, may I ask you to start?
Yes, of course. So I hope you can hear me well.
We do.
Excellent. So it's a pleasure to be here in this very nice format of a 24-hour webinar. And so as Hans-Helmut said, I'm going to talk about the ECB's response to the pandemic. And of course, this pandemic is a shock of unprecedented intensity and severity. And the challenges that all parts of the economy are facing in dealing with all these consequences, economic, humanitarian, and social, are historic. And of course, this also concerns central banks. And in my remarks this morning, I would like to explain a bit how the ECB responded to all these challenges, and how our response is contributing to mitigating the economic and financial fallout from the pandemic, supporting firms and households in the entire euro area. And I will also show some tentative evidence that suggests that our measures indeed have helped stabilize broad funding conditions in the euro area, that they have helped to improve market liquidity and reduce market volatility, and thereby they have safeguarded the financial conditions that are necessary in order to achieve our price stability mandate. And so I would like to move to the next slide, please. On this slide, you can see that euro area financial conditions have tightened significantly in response to the global outbreak of the pandemic. So what this graph is showing you are so-called financial conditions indices, and these summarize our monetary policy stance by considering price movements in equity, bond, foreign exchange, and money markets. And you can see that these indices signaled a sharp and abrupt tightening in recent weeks. So if this indicator goes down, this means financial conditions are tighter, and you can see that very clearly, especially on the right-hand side of the chart. So in a matter of days, the pandemic basically reversed the previous easing of financial conditions that we had seen before, and this threatened to lead to a dangerous macro-financial feedback loop that could have put at risk the ECB's price stability mandate and could have endangered financial stability more broadly. And therefore, swift and determined action was needed in order to ensure that what had started as an economic and a health crisis would not turn into a full-blown financial crisis with self-fulfilling and destabilizing price spirals and fire sales. And so our actions were guided by two overarching objectives. So the first is to restore the orderly functioning of euro area financial markets, which suffered from an extraordinary degree of volatility, fast de-risking, and thin liquidity conditions. And second, to ensure that our accommodative monetary policy continued to be transmitted to all parts of the single currency area, thereby supporting firms and households in shouldering the substantial economic and social costs that this crisis would imply. And in achieving these objectives and in calibrating our monetary policy response, we had one very important asset, and this was our large and tested toolkit. So this meant that compared to previous crises, the starting point of our discussion was a widely shared sense of the benefits and the costs of the different instruments that we had employed in the recent past. And so, for example, a further cut in our main policy rate, the deposit facility rate, would have been unlikely to support sentiment and market functioning at a time when the bank's profitability was already expected to come under additional pressure due to the crisis. And these previously tested instruments also meant that our decisions could be put in place much more swiftly. So this accelerated our response time. And because this experience with unconventional monetary policy measures was actually widely shared also within the global central banking community, the global monetary policy response was actually much more synchronized than on earlier occasions, and this is likely to have reinforced the confidence effects in financial markets. So if you look at our response, this comprises three mutually reinforcing and complementary components. So the first are broad-based asset purchases, which are to address the liquidity and heightened volatility in core segments of euro area financial markets that threatened to impair the smooth transmission of our monetary policy. And of course, the temporary pandemic emergency purchase program, in short, the PEP, constitutes the core of this component. And as you probably all know, this foresees purchases at a volume of 750 billion euros of eligible private and public securities throughout this year and longer if needed. The second component of the package consists of measures that ensure that banks remain reliable carrier of our monetary policy and continue lending to the real economy. So our enhanced targeted longer-term refinancing operations, TLTROs in short, as well as our comprehensive set of collateral easing measures are part of this component. And the third component relates to our traditional role as a lender of last resort to solvent banks. And as part of this component, we offer banks liquidity over longer horizons at the rate of our deposit facility, that is at a negative rate without any conditions attached. So let us move to the next slide. And I would like to start with the first component, which are the asset purchases. And I would like to explain how these have contributed to improving the liquidity conditions and the pricing behavior in the euro area sovereign bank markets, which are, of course, central to policy transmission because they form the basis for the pricing of other assets in the economy. And a simple measure of our effective monetary policy stance is the GDP-weighted euro area government bond yield curve, as shown on the left-hand side of this slide. And so what you can see on the in the graph is that in the wake of the corona outbreak, this curve actually dislocated quite a bit, leading to an effective tightening of the monetary policy stance. So we moved from the red curve to the blue curve, and what you see is that there was a general upward movement at all tenors, and there also was a steepening of the curve. And as a result, just before the announcement of the PEP, this GDP-weighted 10-year euro area sovereign bond yields were around 70 basis points higher than before the outbreak of the pandemic. And I should mention that even German Bund yields had risen by around 20 basis points over that same period. And what you can then see is that the announcement of the PEP helped break this dynamic and that it partly reversed the steepening of the curve. And what it also did, and this is very important, it reduced the fragmentation that had become increasingly visible as the pandemic spread at a very different pace and intensity through the single currency area. And you can see this very clearly on the right-hand chart. So everywhere in the euro area, the spreads relative to German bonds then fell measurably upon the announcement of the PEP. And this persistent heterogeneity in the euro area has, of course, been a long-standing concern for our single monetary policy because it severely complicates our job. And the current crisis actually exposes these vulnerabilities once more with vigor. The PEP was therefore deliberately designed with the view that it should be ensured that this purely exogenous shock caused by the coronavirus would not exacerbate and deepen this heterogeneity through macrofinancial channels beyond the already wide-ranging economic and social repercussions that this crisis brings about. And therefore, within the PEP, the purchases can be allocated flexibly across time, across asset classes, and across jurisdictions. And this is also why the Governing Council decided to make the bonds issued by all euro area sovereigns, including those issued by Greece, eligible for purchases under the PEP. But nevertheless, and you can also see that in these graphs, financial conditions, and this is true even for sovereigns with higher credit ratings, such as the Netherlands and France, which are also shown on this slide. And there are two broad reasons for this. And with this, we move to the next slide, please. So the first relates to the fiscal and economic implications of the crisis. What we are seeing is a substantial increase in the issuance needs of sovereigns, which is putting upward pressure on sovereign yields. And you can see the gross issuance of the past and the expected issuance for this year in the left-hand chart. So this chart is based on Eurosystem staff estimates, and it includes the issuance of bonds, so not including bills, by the central governments of Germany, France, Italy, Spain, and the Netherlands. And you can see that this issuance will be well in excess of 1 trillion euro this year alone. And it's actually likely that these numbers will even increase further. And such significant and concentrated issuance, of course, also implies that investors require a higher premium for absorbing the additional duration risk on their balance sheets. And this is then where our purchase programs, and in particular the PEP, kick in. Because by absorbing a substantial fraction of this additional duration risk on our balance sheet, our measures have an important stabilizing impact on the euro area sovereign yield curve. And this view is corroborated by evidence from term structure models, which is shown on the right-hand side. So what you can see here is that for Germany, there was a quite sharp turnaround in the term premia, and hence in yields in the run-up to the PEP announcements. And so you have to look at the red bars, which give you the term premia in this graph. And this reversal reflects expectations of a strong surge in issuance. And what you can then also see is that the PEP actually interrupted and reversed this dynamic, and thereby it contributed to safeguarding the financial conditions that are consistent with our primary mandate. But because of the wide uncertainty regarding the ultimate economic and fiscal effects of the crisis and the likely substantial additional issuance needed in coming years, the yields have not fully reversed and remain above the pre-corona levels. And with this, I would like to shift to the next slide, please. And in fact, these effects that I described are likely to have been aggravated by a second factor, which is challenging market liquidity. So although the announcement of the PEP triggered an improvement from the previously impaired levels, we see that liquidity is actually still far from normal. So the left-hand side graph shows you bid-ask spreads in a very liquid market, the German Bund market, and you can see that these bid-ask spreads actually remain well above the norm. If we talk to our Eurosystem portfolio managers, these very often report that there's a limited amount of offers, and sometimes there are no sufficient quotes for bonds, and this is particularly true for those issued by some smaller jurisdictions. And so in order to improve liquidity and reduce volatility, we decided to use the flexibility of our asset purchase programs, both the APP and the PEP. And as you can see on the right-hand graph, we increased our presence in the market substantially by front-loading the purchases. And in fact, the current weekly purchase volumes far exceed the levels we have implemented over the lifetime of the APP so far, which is shown on the very right-hand side. And this is true even compared to the period when the purchases were running at a monthly pace of 80 billion euro in 2016. And I would like to stress that the Eurosystem has been using all the inbuilt flexibility of the programs, not only over time, but also across jurisdictions and market segments. And so the hope is that these purchases will contribute to crowding in other private and public investors, thereby reducing the liquidity premia and restoring orderly trading conditions. And in this way, our measures offer an important bridge into hopefully better times. And very similar considerations have guided our decisions for mitigating the impact of the crisis on the funding conditions of firms and banks over and above the effects running through the sovereign yield curve. So from the very beginning of the crisis, we were conscious that the extraordinary liquidities, that an extraordinary liquidity support was needed in segments of the financial and capital markets that were directly exposed to the fallout from the pandemic. And for this reason, we decided to redirect a considerable fraction of the additional 120 billion euro purchase envelope under the APP, as well as of the PEP for eligible private sector bonds. And these private sector purchases, which also include commercial paper, directly contribute to credit easing for non-financial corporates. But since the euro area is traditionally a bank-based economy, measures supporting the liquidity in financial markets were unlikely to be sufficient, and hence they needed to be accompanied by measures that ensured that financing conditions for small and medium-sized firms would remain equally attractive. And these considerations form the core of the second and third component of our response. So the goal is to preserve viable bank lending conditions and to act as a lender of last resort to solvent banks. And so let us first have a look at the firm's market-based financing conditions, which are shown on my next slide. So on the left-hand side, you can see that corporate bond spreads had risen sharply before the PAP announcement. Then you can see that the increased purchase of corporate bonds under both the APP and the PAP have visibly contributed to stabilizing credit spreads, both for investment grade and high yield issuers. And then on the right-hand side, you can see that or at least the graph suggests that it has also contributed to stimulating a private bond issuance. And the strong revival of the primary market for corporate bond issuance is actually an important pillar for supporting liquidity buffers of cash-stripped firms. So you can see that immediately before the announcement of PEP, there was very little issuance, and then it picked up substantially. And this is especially important in view of the evidence that many firms have started to heavily draw down bank credit lines, which is also weighing on bank capital. And of course, issuance offers an alternative way of providing liquidity. However, we see that similar to the sovereign space, the market-based financing conditions for firms are still significantly tighter compared with the conditions that prevailed over the preceding years. This, of course, reflects the massive impact of this crisis and also the large uncertainty regarding its effects. Our measures in support of bank lending, together with the loan guarantee schemes provided by many governments, attempt to mitigate this type of friction. And in particular, for counterparties that are able to maintain their levels of credit provision to the real economy over a defined horizon around the pandemic, at their current levels, the rate applied to our new targeted longer-term refinancing operations can be as low as 25 basis points below the average interest rate on the deposit facility, which currently would imply a rate of minus 75 basis points. And by providing strong monetary incentives for banks to maintain their lending to the real economy under the TLTRO III, we contribute to more favorable bank lending conditions, which tend to exhibit a much larger degree of inertia than the market-based funding costs. So if you look, for example, at Italy, you can see that, that bank lending conditions for firms remained remarkably resilient in recent years, despite significant swings in market-based funding conditions. And again, our measures can provide a valuable bridge to the future and help keep the aggregate external funding costs of firms stable until the economy recovers and uncertainty diminishes further. And then finally, two other features of our package reinforce this bank lending channel. And these are first our, let's say, plain vanilla longer-term refinancing operations, the LTROs, and these provide abundant liquidity to banks at favorable rates at a time when especially term funding has become scarce and more expensive. And then the second feature relates to the easing in collateral standards for lending operations. As was announced last week, we now accept a much broader set of assets as collateral, including loans, even of relatively small size, to small and medium medium-sized enterprises or even to self-employed workers. And we accept this collateral at more favorable conditions. And this then increases the liquidity of the asset side of banks' balance sheet and thereby provides further incentives to extend credit to the real economy, even during these challenging times. So taken together and together with all the actions taken at European and national level, our measures provide a tangible support to the euro area economy at a time when uncertainty is very large and the downside risks to the medium-term inflation outlook have increased. And this is shown on slide 6, which is my final slide, by the way. Of course, our staff is currently assessing the extent to which the current crisis will affect the likely future inflation and growth trajectories. And in the short run, the headline inflation can be expected to drop quite a bit on the back of the decline in energy prices. And the March HICP release was a harbinger of what can be expected in coming months. In the medium run, the effects of inflation and on underlying inflation in particular will depend on two broad factors. First, the depth and the persistence of the shock, and second, on the effectiveness of the economic policy measures taken in response to the crisis. And although it is too early to assess the full impact of these measures, there is tentative evidence that the fast and resolute policy actions by authorities worldwide and by central banks in particular have already contributed to restoring a cautious confidence among professional forecasters. And in fact, this graph here gives you a slightly more optimistic picture than the one that Hans-Helmut drew in the very beginning. So what you can see here, so it shows you the consensus forecast for GDP growth and inflation. And what you can see is that according to the latest forecasts, and these are private sector forecasts, there's still expectation of a V-shaped recovery for the euro area with a sharp mean decline in GDP of 5.7% in this year and a rebound of almost similar magnitude in 2021, which is shown on the left-hand side of this chart. And then as a result, while the inflation expectations for this year have dropped sharply, the revisions to inflation expectations for the coming years, in fact, have been limited, and the private sector forecasters continue to see inflation in the euro area converging to levels closer to 2% over the next 3 to 4 years. However, there are two caveats on this. So first, as you can see, the uncertainty around these estimates is huge. With the forecast for next year's inflation, for example, ranging from minus 0.4% to plus 2.5%. And therefore, of course, these midpoint forecasts need to be taken with a grain of salt. And second, these private sector forecasts appear considerably more optimistic than the latest projections by the IMF, which is shown by the yellow dots here, which sees euro area GDP contracting by 7.5% this year and predicts a markedly weaker rebound of only 4.7% in 2021. So let me conclude. So it's of course highly uncertain what shape the recovery will ultimately take. Now we're seeing that the authorities gradually start to ease lockdown measures in some economies, and it's still unclear what this also means for the spread of the virus. What we can say is that the ECB has responded forcefully to this historic crisis. So we have adopted a wide-ranging set of measures that collectively help mitigate the fallout from the pandemic, that contribute to easing financial conditions and that support banks in their efforts to lend to the real economy. And the Governing Council will, of course, continue to monitor closely the implications of the pandemic for the economy and stands ready to adjust all of its instruments as needed to ensure that inflation moves towards its aim in a sustained manner, and also importantly to avoid fragmentation that may hamper the smooth transition of our monetary policy. At the same time, other authorities will have to play their role as well, since ultimately the recovery will depend on the right combination of monetary policy and effective fiscal and regulatory policy, both at the national level, but of course, very importantly, also at European level. So with this, I would like to end. Thank you very much.
Thank you very much, Isabel. That was very comprehensive, concise, and very much to the point presentation. Just what we wanted to hear. Of course, I hope I'm wrong in terms of my soberness with regard to what will happen. And maybe I'm too much biased on looking at what's happening in the US. There, this thing is really falling completely apart. And I'm not sure whether we really acknowledge all the interdependencies. So it's very, very much reassuring the way you presented it. And I was really struck by the way you insisted on looking at markets, financial condition indicators, and also at the nitty-gritties of dysfunctionality in terms of spreads and so forth. So I think that's really reassuring. And this time around, it's simply different than it was last time. Last time was much easier. It was just disrupted interbank money markets, at least initially. So thank you so much. Lucrezia, may I ask you to chip in? And also for those who are listening to us, we have a Q&A box where you might put some questions. Lucrezia.
Okay, thank you very much. And thank you, Isabel, for a very comprehensive and clear presentation of where the ECB stands at this point. I mean, it is clear that the outbreak of COVID-19 pandemic has declenched a big shock and an unusual one, because this, unlike 2008, did not start in the financial sector. It is a shock that in a certain sense is induced by the need to contain the pandemic. So it has to initially have to do with a shutdown. But now is probably going beyond that, because we know that it is likely that the supply shocks will have an effect on the demand, and the demand again on the supply, and so on. And there is also a huge uncertainty on how phase 2 will actually unfold in terms of the gradualism to which normalization will occur, and possibly also the return of second or third waves on the pandemic, as we have seen in Asia. So it is my view, for whatever it's worth, that this is not going to be a V-shaped recovery. It is likely that the effects will be permanent and beyond 2021. One observation about the private sector forecast, but also the official forecast, is at this point, these forecasts are basically conjectures, because the data are arriving very late. So we are relying on soft data, unusual data, which historically have very weak correlation with the fundamental economic activity. So we really, these forecasts are based on assumptions, and therefore we have to put very, very large standard errors around them. The statistical uncertainty is huge. The experience of other slowdowns show that when the shocks are so big and persistent, this was also the case of 2008, recoveries, and also global, recoveries are very slow and have permanent effect. Remember the discussion that now seems to be ages ago about the slowdown of potential growth after 2008. And, you know, the big discussion about whether we are in a, you know, in a regime of very slow potential growth, and this possibly is related with the hysteresis effect of the last crisis. Now we have another one, which seems to be even larger. So, you know, we really have potential growth. And what would that mean? And especially this is important for what the ECB is supposed to do, for liquidity tensions and possibly also solvency issues. And we know that, you know, the central banks are very good in dealing with liquidity, but, you know, when, you know, in real time, distinguishing between solvency and liquidity, it is difficult. This is also a lesson that we learned in 2008. But actually, we have to be very aware that because of the imperfect federation and the asymmetric federation, which is the Eurozone is particularly prone to self-fulfilling liquidity crisis on the sovereign debt. And here the ECB has a very important role to play. Now, what about the package? The package is really impressive. And, you know, chapeau to the ECB. After, you know, a little initial hesitation, you really went for it. You know, in my view, I mean, to be, you know, to have a broad, you know, view of this package, you know, we know that this kind of QE credit easing, quantitative easing type of package have to be successful, have to have three characteristics. They have to be open-ended. And, you know, this is the program, it is open-ended. To be flexible, so I welcome the flexibility. And then also an important aspect is the asset purchasers should not claim seniority status. This is very important for the sovereign. I remember, because, you know, those were my times, that when the S&P was launched in 2010 was a large package, but the insistence of seniority was a problem for the credibility of that program. So we learned a lesson there. Another important lesson of 2008 is the fact that the central bank must act as liquidity backstop for financial market. And this is not just about monetary policy. This is really an issue of financial stability. So, for example, you know, the central bank provides liquidity as much as necessary and act as market maker. So it's a function which goes well beyond the traditional function of lender of last resorts. This is what the ECB is doing today, for example, in the commercial paper market, replacing mutual market funds, for example, and act as intermediary. So the central bank replaces the market function. And this is what they did in 2007, already in 2007, before Lehman, in the interbank market. And that was probably the period in which, in that phase, the ECB was more successful. And this is clearly within, you know, the traditional mandate of the central bank. Other central banks have done it as well, and you know, this is something that I think now we know how to do. We know what it means. Now it is also clear that what the ECB is doing today must be complementary to you know, what governments are doing at the level of budgetary fiscal policy. Here is where the problems come, okay? Because although in some countries the fiscal packages that have been put in place have been very impressive, in countries where there is less fiscal capacity, there is obviously less room to go for you know, for fiscal policy. And in absence of a convincing response at the level of the fiscal authority, common response at the level of fiscal authorities, there is the risk that the ECB will remain the only game in town. And you know, down the road, we'll be called to implement policy. We may potentially have large geographical bias. Now, as an Italian, you know, I'm not going to be the one, you know, crying complaining about this, but, you know, it is likely that if the weakness persists, this is going to be, you know, an issue of contention. And this, in my view, will test the political limit of a system which is so asymmetric because it has built in an asymmetric way, of course, by the treaty, but also because the decision-making process is different. I mean, if you think that, for example, in the stability, in the European stability mechanism, we have to have unanimity for decision, while in central banks, we have, you know, majority is sufficient. But this is not just an issue of the geographical bias. We also know that at the zero lower bound, at the effective zero lower bound, you know, we need coordination between monetary and fiscal for effective macro management. So when we go beyond the liquidity provision function and the financial stability function, but more to the macro management, then, you know, the issue of coordination between fiscal and monetary becomes very important for effectiveness. And, you know, I know that this is controversial, but my reading of the evidence before pandemic of how effective the non-standard policies of the ECB have been in the macro sense, I mean, for GDP and for inflation, it's at least controversial, okay? My reading is those effects have been small when just beyond the times in which markets have been financial market has been dysfunctional. We know that when financial market are dysfunctional, macro effect, those policies are effective. But as market stabilize, then it is likely that you know, the macro effect of non-standard monetary policies at the ECB will not be that great, if not you know, complemented by a strong you know, fiscal action. So today I would say is we have this contradiction. We have a very active ECB. Some impressive fiscal package in some countries, in particular Germany, but other countries are constrained, and government are not being that effective in coordinating an act. You know, next week there will be an Euro Council meeting, which is very important, but it doesn't look like there is an agreement to go for a big bazooka. Now, if there is, assuming that there will not be any agreement, and you know, here I'm not totally pessimistic, okay, because I see that the Commission is very proactive and there could be things, but you know, we always have to assume the worst scenarios, you know, the scenarios in which there will be very little in terms of a common fiscal response. Then we will have to expect, you know, asymmetries. We know that this shock has been symmetric, everybody has been hit by health, but you know, it is likely that the effect will be asymmetric across countries and the response will be different. Then we will have to expect the tensions on the sovereign market. Remember that notwithstanding the new package from the ECB, the Italian 10-year bond has increased 60 points in the last 20 days. So we can see already some tensions there. And then, you know, this will, you know, will constitute a pressure for the ECB to act asymmetrically. We know that you have the flexibility to do it, but you know, we also know that to be convincing, you have to have a strong support in the Governing Council, and also an implicit support by the governments, because after all, no matter what is the power of a central bank, the legitimacy and therefore the effectiveness of its action depends on the backing of governments. And so this, I think, is very important, and definitely is a matter of concern. Now, I have also some, so you know, let me continue on these bad scenarios that the ECB will remain the only game in town. So what's going to happen? And, you know, a question for Isabel is, you know, what are the real limit of ECB action? I mean, you know, the political limit as well as, the technical limit. So in here I see a tension which at some point down the road will have to be clarified. So on one hand, you know, there is this hierarchical of objective, of course, inflation, but also the responsibility that the ECB has to preserve the stability of the financial system and the integrity of the euro, okay? But this, you know, objective may imply to have to, you know, in a way, implicitly, indirectly financing government or possibly even insolvent institutions. I mean, this, we have seen it, you know, as a consequence of the 2008-2010 crisis, and I'm sure that it will happen again. So is there not a need to clarify, you know, what is the, you know, relation between these different objectives, and what is, you know, a kind of more reasonable governance and understanding of this, you know, possibly contradicting goals than what we have now, which is very much based on a rhetoric which, you know, is based on a consensus that actually was the consensus of the 90s, which led to the treaties, but then possibly today, you know, is challenged by, you know, the big changes in the situation. So beyond that, of course, you know, the heterogeneous fiscal response will have implications for inflation, both at the aggregate and at disaggregate level. We could possibly see large divergence in inflation across countries. I mean, I expect, you know, tensions towards deflation in some of the countries which are more challenged, but it is not completely impossible that as the economy recovers, we could have some inflationary tensions emerging in some of the northern countries. And again, okay, so that will actually, you know, pose a problem, and also, you know, a clarification of what exactly the inflationary target means in its medium-term orientation, and I will come back to that in a minute. Now, another point, perhaps, I think that amongst the innovative programs that you have put together, we have you know, this program of accepting as collateral SME loans, which are guaranteed by the state. This, I think, is a very interesting innovation. It's very important because a lot of the problems involve SMEs, and the SMEs are the backbones of our industrial sectors in Europe. But actually, also, I see there that you know, that the guarantees that are implemented by governments for these loans are quite different across jurisdictions. So I wonder how this is reflected in the pricing of the collateral, whether you consider this is a problem or not. I mean, this is also related to the point of the asymmetric response. Now, more broadly, you know, I can see down the road a big doom loop, a big correlation between bank and sovereign risk, which is an old story, as Isabel knows very well because she has worked on that. So any thoughts that you have about disintermediating the banks? Of course, you have the commercial paper program, which is very important because, you know, that's market finance. But this is actually the market finance in the euro area is very small, very, you know, also related to, you know, especially to France, as I understand. But, you know, what about, you know, the banks? Okay, so have you thought of other ideas? For example, you know, support export finance by involving the European Investment Bank. Again, we can think of the European Investment Bank issue guarantees or buy trade certificates, while the ECB could buy papers through the banks, that market maker type of function, but sidestepping the intermediation of banks, which would, you know, is the doom loop problem that we think it's very problematic. Now, if we are thinking long term, I think there is a possibility that the ECB will have to do even more. It is then, I think, that will be very important to clarify the hierarchy of objectives. It is also very important to clarify the nature of the inflation target. I understand that this is one of the issues in the strategy review. So my question is whether this crisis will have an effect on the discussion of the strategy review. I think it's very important to clarify at least the fact that the target has to be symmetric and the medium-term orientation. So, you know, in the past, you have paid too much attention to, you know, commodity prices and oil prices in particular and made some mistakes. Remember the interest rate increase, two interest rate increase in 2011. So you have to have, you know, clarification which would lead to a tolerance of inflation going temporarily above the target as well as below. And possibly also consider, you know, other targets like nominal GDP targeting, for example, that maybe this is to us too much. Importantly, I think that the ECB and governments have to be, you know, be involved in a more mature discussion about the governance of coordination that would allow for more coordination between monetary and fiscal policy. I think that to say, you know, we are independent, so everybody does whatever is not sufficient anymore. You can have independence with coordination, and I really advocate for something like that to happen. Thank you.
Thank you very much, Lucrezia. Some of the questions you raised, I actually suggest to Isabel not to respond to. She probably cannot talk about the mandate. That's somehow be above the pay grade of technocrats. But you addressed three issues which are really important, and maybe because Isabel has to run just before noon. So the first one is about this issue of how confident can we be that it will be V-shaped. Italy has never seen a V-shape after the last crisis. Japan, neither. So the confidence in, you called them conjectures, in that rapid re-emergence of these economies is probably much too optimistic. And then monetary policy will be faced with the issue of liquidity versus solvency. That was your second point. The third point is about coordination amongst fiscal policy and monetary policy. And you for sure know how northerners in Europe would respond to that. They wouldn't only refer to autonomy and independence. They would also highlight that there's a very high heterogeneity in terms of variety across fiscal space in the euro area. That's a deep issue which possibly the ECB cannot address given its mandate. Though I think it's very important to think about these issues. And I was wondering when you referred, and then I hand over to Isabel, when you referred to European bank-based. If you look at the US, where the Fed is now intervening in municipal bond markets, actually also trying to get some liquidity to firms way beyond what they did last time around. There's a massive complaint at the level of small and medium-sized firms who do not have, of course, any access to capital markets. And they don't get any funds from banks either there. So I tried to be a little bit protective of you, Isabel. Could you come in now?
These were fascinating remarks by Lucrezia, and obviously I cannot answer everything, but let me say a couple of words. So first, so the V shape is not my my forecast, my projection. I was just reporting on what the private forecasters have said, and of course they may be wrong. And there are, just as you too, there are quite a few people who are much more pessimistic. But what I would like to stress is that what is going to happen is not just the result of the shock, but it's mostly the result of how this shock is now reinforced by other things, like these macro financial interactions that I mentioned. And I think this is where central banks have a very important role, and of course also fiscal policy. So we have to do everything in order to avoid all types of pro-cyclical effects, which make the crisis even worse, and which also turn this temporary shock into a permanent shock. I mean, that was also one point that Lucrezia made, which of course is very important, that one has to be afraid that this originally temporary shock will actually have a permanent effect. And I think this will all depend very much on how policy is going to react. And of course, it's clear that this has to be a combination of fiscal and monetary policy. And it's also clear that a monetary policy is much more effective if a fiscal policy is acting at the same time. So this leads us to the question of coordination. I mean, what I learned in my short time at in central banking is that the timelines are so very different. So of course the central banks are looking very carefully at what's happening in markets, and there's often the need to react very quickly. Whereas politicians always take a long time. They have to negotiate, and they make proposals, and then there are discussions, and that takes very long, and therefore even in practical terms, coordination is not simple. And there's of course always the issue that the ECB or other central banks will go first, and that then the governments have lower incentives to act. I mean, my hope is that by stabilizing the situation, the ECB has actually also created space for the governments to react, because they are now not in a hurry. They can take a bit of time, not too much, but I mean, it's of course much more difficult if you are in a financially unstable situation. But for the outcome of this crisis, it will be crucial what comes out on the political side, especially at European level. And Lucrezia rightly stressed that it will be very important what's going to happen in the sovereign bond markets. I mean, the recent developments that we've seen, of course, were partly related to what are also stressed to these huge issuances coming up. But of course, it's also related to the political debates that we've seen both at national level and at European level. I also think one very important point that Lucrezia made is the doom loop. You're right, that has been something that concerned me a lot already before this crisis. And what we're seeing now is that this kind of the connection between sovereigns and banks is even reinforced a lot, not least by the fact that the strength of the national responses on the political side are so different, related also to the fiscal space. And it's also perfectly right that there symmetries, and this has to be avoided because this really hampers also the transmission, the smooth transmission of our monetary policy. And I would like to stop here. And actually, I probably already have to run because we are having a meeting now.
Thank you very much, Isabel. Thank you very much, Lucrezia. We for sure will continue on this one and hope all the pessimists are wrong.
Exactly.
Thank you very much.
It's a good final word. Thank you very much. It was
Thank
a pleasure.
you, Isabel, and good work.
Thank you, Lucrezia.
Good luck.
Thank you.
Yes, thank you.
Thank you very
Bye-bye.
much. All right. Yeah, thanks to all the panelists of this first session. I realized that the panelists for the second session are already there. And it ties in very nicely with what we have done now. And just for those who are participating in the marathon, let me assure you, you're half through. So it's noon now in Central Europe, meaning that you've done 12 hours by Lucrezia. So you've done 12 hours of the marathon. There's only 12 more to go. And to make that as easy as possible, we try now to have another exciting panel, which comes back from the macro perspective more to the micro questions, some revolving theme. The discussion of Isabel and Lucrezia was essentially what else can be done, fiscal packages, and in particular, how can we actually get funds and liquidity to SMEs? And I'm thrilled to have a panel of distinguished speakers waiting with Jan Krahnen, who's with the University of Frankfurt, and SAFE, presenting a paper that he's co-authored with a lot of colleagues that really thinks about how we can provide funds to businesses in an efficient way. And this will be discussed by Yishay Yafeh from Hebrew University and Andreas Engert of the Free University of Berlin. And also, again, limiting my role to the minimum, I immediately turn over to you, Jan. We look forward to your presentation.
I have to hope my microphone works. Thank you very much, Tobias, for having me in this session. I'm glad I have a chance to speak and present some joint work with colleagues that I will show you in a second. But for a short moment, I want it also to be on the screen so everybody can see me. And then I will speak a bit from the off because I have a few slides that will probably carry us about 15 to 20 minutes into the session. And during that time, I want to explain a rather generic approach to our topic of what does the corona crisis do to the economy and to the financial system. And that is generic in a sense that we try to construct and talk, let's say in financial economics terms, about how rescue packages are being structured. So we speak about government help, basically, or government programs that are currently devised and designed all over the place. And we, in that sense, we walk away from the last session where it was on monetary policy and monetary policy measures. But there were several issues mentioned in that session, and I will allude to them in a second, that really are a wonderful bridge to what I want to present. Now, let me first try to bring the slides to you. Let me just see where are the slides are. I think I have to go there. Just a second. I am there. Okay. Okay, and I'll pick the right one. So with some luck, you should see the title of my talk, my name, and also the acronym of our institute, SAFE, stands for Sustainable Architecture for Finance in Europe. And it's a newly founded Leibniz Institute here in Germany that really focuses, and it's in the build-up phase, it focuses on financial architecture and financial instruments and financial stability and these type of issues. And that is, so to speak, a good moment for us to think about the current topic. So I just want to see that I can move the slides. Yeah, I can. So what you see here is a list of people who have been basically writing these 3 papers, and we are currently working on a 4th one. But these 3 papers have in common the generic development of the issue, how should we tackle the crisis that is basically developing in like a financial crisis in slow motion? How can we analyze it? what are the features, what are the sequences of events that we see or expect to see, and how can we do something effectively against the further, let's say, growth of the crisis part of that development. So you see among the co-authors also Hans-Helmut, who was just sharing the last session, so, and other people, Arno Booth, Elena Caletti, Loriana Pellitzon, and Marty Subramaniam. So the basic connection to what we have just heard is basically in this chart. I just want to remind us of two statements that I noted down while listening to the last panel. Isabel Schnabel was talking about the cash-stripped firms that are trying to get liquidity at the moment, which explains the huge new primary market activity on the corporate bond market. And also that firms are now driving down the credit lines. Both are observations that she made and that also entered partly into her graphs and statistics that she showed. And Lucrezia Reichlin was pointing out that in particular, those firms that have limited access to capital markets are really, in a way, important in our understanding how the rescue packages will reach their destinators, namely the small and medium-sized enterprises, which she called the patrons of the EU economy. And I have something to say on that later, but I think this connects what we are going to do nicely to the earlier stage. And then she spoke about the doom loop, and the graph that you see here, and I'm now moving my mouse, I hope you can see that. So we basically start on the left side of the slide, which basically tries to give a graph of what we are seeing unfolding. What we really see is almost like the opposite directional development from what we saw in the 2008 financial crisis, where everything started in the financial sector in a moment and then basically rolled out in the rest of the economy and reaching the real sector, the corporate sector, only with some delay. And here, currently, we have the opposite direction. Everything starts, if you wish, outside the corporate sector at the health, in the health level, so to speak, at the people's level. But from there, it migrates into the corporate sectors with all the lockdowns and with the broken supply chains. And if the corporate sector has trouble, it's really a liquidity gap that has to be filled. If we assume a V-shaped recovery, as was just discussed, let's assume this for a second, then we have an interruption in economic activity that is reflected on the cash flow side, that's been reflected also at the cash flow side at the corporate sector. Since the firms there are desperate for cash, they will use all available facilities, including credit lines and new loans, and of course, any sort of rescue that may reach them through the banking sector or through other channels. But this, in the end, will translate into a change in the exposure to future shocks at the corporate level, will make them weaker, and the banking sector will also be suffering with some delay once it realizes that the loan loss provisions are rising. Those of us who have had a glimpse at today's FT see that this is already the cover story on the first page, how loan loss provisions really are hitting US banks. And then it goes on, because the whole crisis will lead to a lot of government activities trying to hinder the financial crisis in slow motion. And by that, they raise money themselves, get further indebted, and you can easily see that this will translate at some point also into problems that reach the sovereign level. Again, if you look at today's FT, you will find a longer article on exactly this problem. So that's the setup, and we take this as a basic, let's say, a basic force that's unraveling as we speak, and we want to know what can we do. And I want to point out two problems that the current extensive rescue programs that are being engineered by governments all around the world, but now I will focus on Europe. So in Europe, two problems that they almost all have in common. The first one is that these programs, in one way or the other, come in the form of debt help in the form of debt instruments. Either there are lending facilities, or there are guarantees attached to lending facilities of all sorts via the banking system or outside the banking system. But in all these instruments, with very small exceptions, you find a rise of debt overall in the system. If it reaches the corporate level, we easily can imagine that firms whose problem is a lack of cash inflow for some time, we don't know for how long, but for an extended period, but building up in exchange for the left out cash, building up debt instead, will eventually have a debt overhang problem. Certainly not every company, but many of them. And the debt overhang, as we all know, has several implications for future prosperity of that company. Particular investment decisions will be affected, and also the lender to these companies will also be affected, because the default risk of companies that keep on building up debt will rise, and that will translate into rising loan loss provisions and so forth. And at the end of that chain has to be mentioned the governments that one way or the other will be asked to help the banks in case they get in trouble. So we are back in the very classical doom loop that is, if you wish, fed and heated up by the very way the help programs are currently designed, namely using debt instruments. That's my first point. And my second observation is that most of the debt programs are national in scope, meaning that the national governments try to protect their own companies. And this is of no big concern as long as these help programs are of, let's say, commensurate size across Europe. But if they are of very different size, and that is what I can show on the next slide, what you see here are the rescue packages that some countries in Europe have set up. And we are taking OECD data of the 7th of April, so it's a few days old. But what you see are tremendous differences across countries that do not reflect the differences in their GDP or employment statistic, with a strong lead on the German side. And if you look at Italy, which arguably is the most seriously hit country in Europe by the pandemic, has only a very small sized program to stabilize its industry. So of course this, I go back to the last slide, this really adds to the competitivity differences that existed already before the crisis. So what is the possibility? And the possibility we are proposing to, let's say, mitigate these problems is twofold. It is, first of all, in order to tackle the problem with debt overhang, with build up of debt around the world and in all of the economy, we suggest to use more extensively another financial instrument, which is simply equity rather than debt. And I'll talk about the details, how such an implementation could look like in a second. But in general terms, using equity instruments by way of construction does not lead to debt overhang problems, actually reduces existing debt overhang problems, and does not build up further default risk in the financial sector, in the banking sector. To the contrast, it will reduce default risk there. And the same is then also true, since we argue about a chain event, for the government or the sovereign viability. So that is one way which we should think about more, and I'll tell you in a second how we think this could be engineered, so to speak. And second thing is, the differences, the huge differences in rescue programs across Europe suggest that these efforts are much more coordinated. And at least to the extent that we would enter into, let's say, a new equity deal that I am suggesting in a second, we should do this not on the national level, but on a European level, thereby inducing risk sharing, and as I will point out, not only that, but also reward sharing. So how do we do it? How do we design an equity type instrument in the current period, in a rescue operation? And I would like to distinguish between large enterprises and SMEs. Large enterprises, in a way, I mean enterprises that have established access to the capital markets, that are most likely stock corporations, and that have very tested and easily accessible instruments at hand to allow for an outsider equity type participation in the future and in the prospects of the firm. I'm just mentioning here as an example preferred stocks or other hybrid instruments that you can think of, along with common shares, of course, all instruments that a company could float and some rescue entity or agency could acquire. That is, in a way, a step, you would say, towards nationalization, but I'll show you in a second that this is not necessarily the case. It all depends on how we design the instrument. And if you look at the header, it says equity type instrument, not equity in the legal sense. And I'll show you what I mean. And second group of firms, and that are the ones that I think are particularly important to take into consideration when we speak about Europe, are the SME sector. The SME sector, just to give you a glimpse of data, these are all 2017 data, and they are systematically underestimating the importance of the SME sector because of some data gaps in these statistics. But in general, we can see that if you look at different criteria, number of enterprises, the value added in the non-financial economy, and the number of persons employed, SME firms command the majority of contributions in all major countries that you see. It's all between 55 and 70% that are really, can be said, are rooted in the SME sector. So this is a dominant force in Europe, and if we want to tailor rescue packages, they should particularly look at these firms. They are the backbone also of Europe's competitiveness, and therefore more important than maybe outsiders of Europe who are more used to capital market oriented economies might know. So this is now the suggestion that we are trying to foster and present here today. That is, we think of a equity type instrument that is a very simple cash for tax scheme. And you can see this graphically. On the top row, we have labeled a European Pandemic Equity Fund. I speak about this in a second, but this is where the money comes from, the pot of money allocated at the European level that is used in very many countries that participate in that fund to distribute cash to firms, cash without any obligation of direct repayment. So it's not a debt position in their balance sheet, but it's like a transfer actually. Of course, this transfer doesn't come without any conditionality in the sense of the cash is not distributed to all companies who raise their hands, but to companies who can receive a positive quality evaluation. So get some, let's say, investment grade in quote unquote way. So some viability is assured. How we do that, we can speak about this later. But that is the way cash is given to firms that are viable, no matter how small. So you can give cash to any firm, even to a sole proprietor, you can give cash. In exchange for this, and that's on the left side of the graph, you see a flow back to the pandemic equity fund. There is a temporary surcharge on profit tax. So we assume that these business entities annually have to put up an account which tells us about the profitability of the exercise. And over a number of years, this sum of money is not only taxed with the usual profit tax or corporate income tax, but with an add-on, a larger amount, and that add-on will flow directly into the European Pandemic Equity Fund as a sort of a payback to the cash that was handed out earlier. So that's the very basic intuition of the whole instrument. Importantly, for the recipient, for the company, the SME here receiving the money does not come along with co-ownership title or with any representation on boards or whatsoever. That's something SME typically abhor. They really dislike co-ownership. Now look at the other side of the European Pandemic Equity Fund. Somewhere the money has to come. And today in this talk, I do not want to go into details here. We can think of various construction, how such the pot of money can be set up at the European level, be it through the EU budget, be it through multilateral funding, let's say via the European Investment Bank or with the help of the European Investment Bank, be it in an extension of that idea that even institutional investors' money would be torn in and put into that pot. We should not forget that the European Pandemic Equity Fund presents a unique opportunity to participate in the future prosperity of the SME sector across Europe. You have only selected the better companies, you have a participation in profits. If these numbers about tax rate, duration, etc. are neatly calibrated, you should expect a rate of return on that fund. And that makes accessible an asset class which otherwise is inaccessible for institutional investors and pension funds, let's say, in Europe. But we don't speak about the funding side in more detail. This is a highly political issue, as we all know, facing now the Corona bonds and Eurobond discussion. So I don't want to delve into this and distract from the real innovation in our idea. The innovation in a nutshell, that's my last slide, is we think that by using and relying much more heavily than before on equity type instruments, we get a better idea of risk sharing that goes across countries, always assuming that we have this European pot of money that's spent that way. But we not only share the risk, we also share the rewards of whatever is the outcome of this action by governments to hinder the financial crisis. So I stop with this and thank you for your attention.
Thanks, Jan. That was extremely interesting. Before I turn over to Yishay, I just want to highlight one thing that I think is interesting from an institutional perspective, because you made it very clear that that you essentially provide equity without governance rights. And if you look at the existing programs, one thing, and that is regardless if the instrument through which the funds are really channeled into the firms, what governments don't like to do is essentially waive governance rights. So even if the help comes in the form of, for example, silent partnership interest, they are typically accompanied with very strong governance rights. So that's probably one tension that needs to be addressed in the discussion. But with that, I immediately turn over to Yishay, and I would ask you, Jan, to just stop sharing your screen. Thanks.
Okay. Oh, sorry. Did you want to say something, Jan?
No, I wanted only to get out of the sharing mode.
Oh, all right. Okay, so I guess most of what I'm going to talk about is related directly to what Tobias has just said. Before that, I really think it's a super interesting proposal. It's not just to be polite, and it has, I think, 3 elements. I will not talk at all about the pan-European element, which is a central feature of this proposal. Harmonizing aid, etc., across European countries. That may be a worthy cause, but I won't spend any of my 5 to 7 minutes on that. The essence of the idea is, let's inject capital in the form of equity, or to be precise and to follow exactly on what Tobias has just said, this is preferred equity, right, with no voting rights to the government, to a sector which is normally not considered feasible for equity-like injections, because these are small companies which are not traded. They may be family firms, they don't like outside shareholders, etc., etc. So I want to talk really very briefly about 2 points. One really briefly, and the other one I will spend most of my time on. So Jan and his co-authors sort of come to this issue, or there are 2 stages, you know, when you try to design a program like this, right? The first one is who's going to get the funding. And the second one is, given that companies of certain attributes are going to be supported, what type of contract should the government have with these companies? Debt, equity, something else. On the first one, who's going to get the money? Jan and his co-authors are totally silent. So it seems like the presumption here is that everyone is going to get the option to participate in a program like this. And then companies which will do well will pay something back in the form of profit taxes, and other ones will not. This premise is worth thinking about, at least briefly, right? Is it a good idea to provide this scheme to everyone? Maybe, I think, to quote Olivier Blanchard in one of these, Blanchard, I should say, in one of these Princeton Bentheim lectures, he said it would be better to err on the side of spending too much. So maybe you want to give it to everyone. If not, and this is related also to the issue in the background, how are we going to help larger firms, if at all? What are the criteria we want to apply? Now, maybe we don't have enough time to really come up with sophisticated criteria, but we might want to at least do something that tries to go in the direction of who's insolvent and who is really only liquid. Jan has assumed that all of this audience is illiquid only. Maybe something to do with employment preservation. I'm just proposing a criterion. I'm not saying that this should be one. And something about access to debt or equity or other sources of capital, so that we don't do this on a universal basis. Or at least we think about whether universal basis is the right way to apply this framework. Now on the second one, which is the essence of the proposal, given that we have come up with a set of firms to whom we want to inject capital, what is the kind of contract the government should have or sign with these companies? Now, let's go for a minute to large companies where the choice is supposedly less constrained, right? In parentheses, you may have read, or you must have read, right? So that the US government is going to bail out the airline industry. Now they are following Jan's proposal in a way by applying this to all carriers, regardless of whether or not they are illiquid, insolvent, totally screwed up, or just temporarily ill. And they're going to use a combination, if I understood correctly, of debt, grants, warrants, preferred equity, everything, yes? I think, you know, my intuition was initially that preferred equity was the way to go, or should be the most important vehicle, because it gives the government priority in getting payback, and it limits the ability of government interference in corporate decisions, which we like to think is not something governments are very good at. Now, this proposal essentially suggests preferred equity for small companies. So companies can do whatever they like. And then if they get money, the government in the form of the tax authority will be able to collect the benefits. In fact, it will be one of the, I guess, in the priority, right? Taxes come probably first or maybe after employee salary. So very high up, but very much like a preferred equity. Now this raises the obvious question in the case of large companies, but it arises here too. How do we make sure that the agency problems that arise immediately are resolved, right? So you are thinking of a corporate entity which calls the shot, a government which provides the money but has no ability to influence decisions, or at least limited ability. How can you make sure that the recipients, you know, think of the government when they make decisions? Now, this is not a problem of large companies, right? In the SME sector that Jan has been talking about, the owner can get a larger salary. That's tax deductible also, right? The owner can buy a Mercedes instead of a Fiat. I don't know what, right? So how do we know that all of this, these issues are addressed at least to a reasonable extent? That applies to large and small companies. The other thing is, given that the government is not going to have any voting rights, again, this applies to both large traded companies and the small ones we are discussing in this paper, can the government, should the government, and can it impose any form of conditionality on the recipients? For example, do we want to maintain certain employment levels? I'm not saying we should, I'm just raising the possibility. Do we want to make sure that executive compensation or the owner's salary, you know, do we want to restrict it in any meaningful way? Do we want to restrict dividends or any kinds of payments to other shareholders? So maybe the preferred equity scheme can do this in traded companies. It's less clear how you would do this in the small companies you're talking about here. In this, you know, at least in large traded companies, there is a lot of disclosure, right? So there is a lot of regulation and a lot of disclosure. So to a fair extent, the government may be able to tell when the corporate executives are doing something that is against the interest of the government as to maintain the same assumption, holder of preferred equity, right? How do you do this in these small companies, SMEs, etc.? Now, it's true that they file tax reports, I presume, but the level of, this is how the system is supposed to work, but the level of disclosure is much, much lower than in publicly traded companies. And the potential of these recipients of capital to do something that is against the interest of the government as the provider of capital here is, you know, at least the potential is there. I'm not sure how this can be resolved. Also on the discussion of whether or not these companies are, you know, cannot borrow anymore. They are going to face a problem of debt overhang. They are extremely leveraged and so on and so forth. Now, this may well be true, but may also apply just to a subset of them if we decide to distinguish between different types of recipients. But you might also think of debt-related instruments. I think I got this idea from my colleague Asaf Hamdani, who may be in the audience. You may design debt contracts, which are not tax deductible. So companies will have an incentive to pay back this debt to the government before paying off other forms of debt. Now, I'm not saying that this is an ideal solution either. I'm just saying that, you know, it's not completely clear that equity is uniformly superior to debt. I have a few more along these lines, but maybe I'm not sure. I haven't been looking at my watch, so maybe I've run out of time. Let me just say one last point, and then I stop. Which is, I mean, this paper takes, or the basic premise is that debt is not good, or more debt is not good for these companies. I would propose, I'm not sure it's true, I would propose at least some kind of a discussion of the pros and cons of debt and equity for large and small companies, debt with some government guarantees through the banking system. So at least some discussion of this premise, perhaps, I mean, the idea is very interesting and is plausible, but maybe, you know, there is a missing step before you say, okay, this is definitely the way to go. Maybe I should stop here.
Yeah, thank you. Thanks a lot, Yishay. This was very, very interesting remarks. I think that before I turn over to Andreas, just one thing, because I was inspired by a comment from the audience to the chat function. Mika Lehtimeki, he essentially said that he hinted at one instrument that could be interesting, solve some of the governance problems, which is a redeemable preferred stock instrument. Because then, if something goes wrong, the government cannot interfere with the entrepreneurial function, but can simply pull its funds back. And this threat should be like a motivating instrument. And therefore, thinking about equity-like structures could end up somewhere in a hybrid instrument, which allows for that design. Because the unfortunate thing in Europe is, from a legal point of view, you can't really tinker with equity structures. So equity is equity, it's not redeemable, et cetera, et cetera. So there are tight limits of that. But I leave it here. Andreas.
So thanks very much for having me and for reading this, letting me read this interesting, very brief paper. So it's very enjoyable to be commenting on such a succinct policy proposal. I do like it a lot. I think it's very innovative. It makes a truly novel contribution to the debate. I like the tone it strikes, that it's making a political case. I also believe that the focus on the European perspective is very important because it is a cross-country shock, obviously, and it is imperative if the EU as a political project is going or is meant to stay alive, it is important that we share this risk across the EU. But instead of wasting any more time with praising the paper, I would like to share a few thoughts about the underlying analysis and how I believe that would affect the design of the program that is being proposed. So the focus of the suggestion is, of course, to focus on the injection of equity. And first of all, I would like to say a few words why I believe this focus on equity is very much to the point. So what is the economic root cause of the economic crisis that is going to come from the coronavirus? It is basically social distancing and the fact that social distancing for a period of time knocks out much of the workforce, and that leads to simply a production shortfall that then propagates through supply chains through the economy. So what is important to note here is that this is a real economic loss. That is, resources lie idle for extensive periods of time, weeks, months, quarters, you name it, and the decline in GDP that we are expecting is mostly reflecting the stuff that we could have produced but end up not producing. So someone in the economy then has to bear these losses. And certainly it is not people like me who earn a fixed salary or pay a fixed mortgage interest rate or a fixed rent. It is not people, generally speaking, with fixed and stable claims for cash flows, landlords, lenders, employees, depending on labor law conditions. It is one class of actors in the economy namely the owners of firms that are the residual claimants and residual risk bearers, as we all know. So that's why I believe the emphasis on equity is really hitting the mark here. So if economic losses of that magnitude concentrate in one type of player, the relative size of the effect on these players will be magnified even further. So if equity has to absorb most of the real economic loss, then that will lead to or could lead to a very substantial drawdown on equity. And such a severe shock on the capital structure of firms can have severe consequences for the economy at large. Apart from the bankruptcies that we are expecting as a result, yeah, Jan Krahnen already mentioned the key word here, which is debt overhang, and which leads to persistent underinvestment, because essentially additional funding to firms mostly will benefit the firm's debt holders, and no one wants to invest new fresh money or effort at that if much of the resulting increase in firm values goes to the existing creditors. So Southern Europe and Italy have experienced in the past the effects of an outsized debt burden on the economy, and the Corona crisis could repeat that experience, maybe even at a larger scale. So I would think that understanding these underlying economics help us to clarify perhaps a bit the proposal that Jan Krahnen and his co-authors make. The paper makes very political and at times even an emotional argument, and as a result it is perhaps a bit less precise and I would think and outspoken about the economic nature of the proposal that is being made. So for instance, there's language in the paper that frames the proposal, and Jan Krahnen has done the same in his oral presentation, that frames the proposal as an investment scheme for citizens. So for instance, they tell us that all citizens can participate in the common risks and potential rewards of a broad-based participation in Europe's industry post-crisis. So that sounds nice and attractive, but I'm afraid my sense is that it mischaracterizes what an equity injection really has to be. Because if the equity injected were an actual investment, it would need to deliver a market return in line with the risk-free rate and the proper risk premium. So existing equity holders would essentially only gain access to investors. They would not gain anything on top of that from the proposal. I'm afraid that is not enough to actually solve the problem, because debt overhang is not a matter of lack of supply of capital. It is an issue of a damaged capital structure that makes it impossible for a firm to offer an attractive rate of return to new investors. So if it is to offer a sufficient return to a market investor, then that can only come at the expense of the current owners of the firm by essentially giving away part of their ownership, even perhaps all of their ownership to the new equity investors. And understandably, that's not something owners of SMEs will easily consider doing. And also, it, especially for SMEs, that wouldn't be a very workable solution, because we need the current owners to run the firm. So in essence, what we might need, I think, is not an equity investment, but rather an actual wealth transfer from taxpayers to equity holders. And the government, in essence, has to pick up some of that real economic harm and spread it over more people and across time. So whether that suggestion of a subsidy from the ordinary taxpayer to business owners is justifiable, say on fairness grounds, that is certainly subject to debate. I think one could make an argument that business owners should bear business risk, but that it would be unfair to ask them to assume the losses from a national or global pandemic in their entirety. But even if we can't agree on fairness, I believe that a wealth transfer from taxpayers to business owners would be efficient, and it would also be beneficial to taxpayers themselves. So in a sense, it would be a gift that pays for itself if it helps to avoid a long-term depression or persistent stagnation. In that sense, it is an investment, but it is an investment in the economy rather than in individual firms as an investment. So this is, I believe, not only a matter of how you frame the proposal and whether you call it an investment or a subsidy or how you sell it to the public, but it also matters a lot for how you design the program. So simply put, if it's an equity investment, you are offering a financial transaction to the current firm owners, and the government expects to make money of it, and you don't have to be selective other than screening out non-viable firms. But if the injection instead is a subsidy, then we need to restrict it to firms that are actually in need of it. So the problem then is filtering out firms that can do without the subsidy, but of course will take it anyway if we offer it to them. I don't think there's a simple mechanism to accomplish this. So the proposal, as we've heard, envisages a tax being levied on future profits. I believe the tax could be designed with a view to making the program more attractive to firms that are more in need of it. So for instance, one could condition it on losses in book equity suffered before the injection. That might be one approach. But in any event, this difference, investment versus subsidy, I think will determine how the program must be structured and administered. And if it is a subsidy, as I would argue, then one has to ensure that limited taxpayer funds are channeled to their most effective use. Thanks very much.
Okay, thank you, Andreas. So can everybody who's not speaking mute their microphone, because otherwise I think we get this feedback. So I think before I turn over to Jan again, in order to allow him to respond to the comments, I just want to draw your attention to one point that has been made by John Macy in the chat function, which is that maybe it's not about redeemable stock, but more about convertible bonds, which would maybe give the equity-like structure regarding governance rights, but also have not the draconian sanction of being the funds being redeemed at some point. So something that I think is also worthwhile considering. Apart from that, Jan, you have the chance to respond.
Yes, yeah, thank you. That were very good comments. So both commentators, thank you very much. As you have probably spotted from the fact that I presented these three papers, the trilogy in the beginning, we are in a flow, so to speak. So we started to do this about 3 weeks ago, and we are just working on the fourth one, which will conclude the series, and which has addresses implementation issues. So I think the most important thing is really the part we are discussing now. It's the general setting. It's the general approach, I would say, to these rescue programs. And of course, once you get into the real details, as always, we as academics are not so good at that. And there are many little stones you can fall over easily. And so I take this not to excuse myself, not commenting on details, but just pointing out that once you get to the details, many aspects have to be considered on top of what I have been talking and we have been discussing so far concerning legal aspects, tax regime, viability tests, duration, and so forth. I mentioned a few in the few minutes I may now use for a response. But I thought, and we thought when we wrote this, it's first of all, first order importance is to get the focus, that we have to give us an opportunity to think out of the dead box that is almost automatically used whenever we go. Now, I think Yishay raised a very good point. It is almost all about corporate finance, what we are speaking about optimal capital structure. And why the hell should it be better now suddenly to have more equity, while before, and I'm teaching corporate finance, I always argue, well, before you change capital structure, you may think why companies sought this structure in the first place, right? And why they differ across industries and countries and so forth. There may be deeper reasons for that go beyond our model, but that may be real. And that's true here as well. So I'm not arguing that is the better instrument per se. We haven't really developed that argument, and that I take from your comment, Yishay, we will do that, right? So I think this is an important thing. My basic idea is the following. The classical debt overhang problem is of course well known, but the shock that we are facing now is like a sudden, widely shared sunk cost increase in the cost structure of the firm. So that debt overhang suddenly rises in all firms. And in that moment, in that situation, it is the choice between debt and equity is not neutral, right? That's basically the more general proposition that one may try to defend in favor of our approach, right? So it's not we are not at the optimum basically where companies had adjusted their capital structure given the normal situation, and we are just in a small volatility environment, and now then it's more neutral where we go. But here, in a way, everybody's indebtedness has risen relative to expected cash flow if we assume a benign V-shaped recovery. Right? If the recovery is not V-shaped, it's even worse. So the first question of Yishay was, is this meant for everybody? And no, it's definitely not intended to be for everybody. It's intended, let's say, for the better half, or maybe a bit more than the better half of the business population, right? So it's for those firms that we expect to be viable. Now, how can you estimate viability in the middle of a crisis? Very bad, right? So in trying to do this, at least we try to write this in the paper. The idea is we assume a V-shaped recovery so that it's really an interruption what we are facing, not a complete restructuring of the industry, but it's a interruption, and firms that were good before the crisis have a high likelihood to be again if they survive, right? And firms that fared poorly before the crisis have a tendency to go down even further and be worse after the crisis. And those that fared poorly before the crisis should not be part of that program. Now, how can you distinguish one from the other? And the only point of reference we presented in that paper is the German rescue program that has been set up a few days ago, which basically, of course, is lending again to companies, but the criterion was the company must have been profitable in 2019 or on the average of the last 3 years, 2017 to 2019, right? So you basically take profitability as one indicator, and there may be others, right? So the others that they are alluding to in the German program is assessment by the house bank, that in their internal rating model, they have, let's say, quote unquote investment grade rating, right? So that is something that works in Germany where you have all banks having internal rating models with their clients. Of course, the question arises, how can you make banks share that information truthfully with some outside body and so forth? So there are more deeper issues that one has to address, but in principle, that information could be used. We condition information viability assessment on the time before the crisis. So that would be the answer. And then we hand out the cash to those firms that have a good forecast in a sense. I jump a little bit through the questions because it now fits to talk about what Andreas was talking about conditionality and also about the price of the money that you give out. Well, you can think of the model that we suggest. We hand out cash without conditionality, so to speak. And in return, we get a corporate profit tax surcharge for a limited number of years. So you have three variables in this model: the amount of money that you give out now, the size of the tax surcharge, and the length of the time that that formula will be applied. Right? And you can make the formula even more complicated, of course. I can speak about this, but take these three. Now you can take real company data and make basically a small Excel model that tells you how high must the tax rate be relative to some number which is related to EBIT, let's say, earnings before interest, taxes, depreciation, and so forth. So you take some number, accounting number, that reflects a sort of the free cash flow of the firm, let's say. And then you relate the payout to the firm to that number. I make it now up 10% of that number is the cash inflow. And the tax rate, let's let it be 5% as a surcharge on the corporate tax that has to be paid anyway. And now you can make a little model and see under what assumptions will this triangle of tax rate, duration, and cash inflow initially produce a positive present value. And by playing around with this on the company level, by taking into consideration the distribution of companies in quality sense or the business cycles, you can make it more and more complicated. You can get at simulations of your sector that gives you some variables, some setting, some calibration of these numbers that produce an expected return of 0 or whatever you want, a positive expected return on your pandemic equity fund in general, which diversifies across Europe and so forth. So that would be my statement. Is this necessarily a transfer or a subsidy? That is, in a way, a political decision, and I wouldn't take a strong stance on this. I think it can work either way. If the governments say we invest a lot of money and we get it back later through the rest of the tax bill that consumers, and that's fine. But it needn't be like this. Right? It could be make expected return positive model, and only under these conditions, private investors would be willing to participate. That's at least our assumption. Now, whether private investors do participate or not, I make no statement on that. But if we want to broaden the capital base for such a program, then this would be a requirement. It must be, at least in expected value terms, something that merits the investment. Okay, so I haven't answered everything. Oh yeah, one last thing to Yishay, I would like to start about large companies. You mentioned the US airline bailout and so forth. So we have, the longer the group that is writing these papers, it talks about it, the stronger we feel we shouldn't speak about large firms at all. Large firms are political animals and become very politicized in the way they are treated, and all sorts of agreements are made in order to preserve national competitiveness or whatever, national champions, and that's beyond our model. We try to develop a market-prone model, a model that would survive in a market setting and that uses mostly market forces to be viable in itself. So that's, in a way, the basic understanding. And if it comes to bigger firms, many of them listed firms, I think other disciplines than economics have a better role, a more important role to play to suggest what should be done there. I think the legal profession and the political scientists play a larger role here.
Can I just?
That's a wonderful closing remark, actually. But the problem is, one thing that Luca and Marco told me, you can do whatever you want through your session, but you have to finish on time. And that means, unfortunately, that we're out of time. So, Yishay, I'm terribly sorry, but maybe you can take it up
Sure.
on a one-on-one. I think this was a great session, very engaged speakers. I have to thank you three, and of course, the speakers and moderator of the first session. We're done in Frankfurt, and wish this marathon a good continuation. Thanks again for joining us. That was fun. Thank you. Bye.